Hello, everyone. This week we will be discussing Chapter 12, Accounting for Partnerships. The different topics we will cover are the characteristics of a partnership, how to form a partnership, how to divide income amongst the different partners, how to admit a new partner or withdraw a current partner, and then finally, how to liquidate the business or terminate it. First, we'll start by discussing the characteristics of a partnership. A partnership is a voluntary association of two or more individuals who have a business for profit. A partnership does not need to be only two partners. There can be more than two, but partnership cannot be one person. Compared to corporations, partnerships are easier to form. Not as easy as a sole proprietorship, but still easier than corporations. I have a link here that I'm going to show you. This webpage is from the state of New Jersey. It explains how to register and start your business. If you want to form a partnership, you can just follow the directions on here. And like I said, one of the advantages is that it is easier to form than a corporation. Every partnership should have a partnership agreement. This is something you might learn in a business law class. This would be a contract stating everything that the partner should know when beginning the business. It covers topics such as dividing income, how to settle disputes, what to do in case of a liquidation. And I do have another link here to show you, which is a template of what a partnership agreement can look like. This is a template from lawdepot.com. You would list the different parties, information such as the name of the business, the purpose, place of business, capital that's going to be contributed to the business, which is something we're going to talk about in a little bit, how to withdraw capital, basically withdraw money from the business, terms on how to add new capital, interest, what to do for profit and loss, annual reports, the fiscal year, auditing it, management, meetings, how to admit a new partner or withdraw a partner, and we will discuss this as well. And if you go through this, you'll see that there's a lot of information here. Dissolution of a partnership, this is the termination or liquidation of it, which we will also discuss. This is just a sample. You can have whatever you want in the contract, but it should be very extensive. And I do recommend seeing a lawyer to help you make one if you do decide to open up a partnership. When you form a partnership, all property is co-owned by all the different partners. For example, if I contribute my printer to the business, that is no longer my printer. It is now owned by all the partners. The assets in the company are co-owned by the business by all partners. Another topic to be mindful of is the taxation for a partnership. A partnership is considered a flow-through entity. A flow-through entity means that all the income from the partnership will be passed through the partnership to the owners. If my partnership made $1 million this year, the partners will receive that money, and then the partners will have to pay those taxes on their tax return. The partnership does need to file a tax return, but does not pay any of the taxes. The tax return will show how much money the partnership made and what each partner's share of that income is. This is an example of a tax return for a partnership. It's very similar to an income statement. This first section will list the income of the partnership, and the second section will be the expenses or the deduction in order to determine net income. Then that income will be reported for each of the different partners. This is a Schedule K1. A K1, think of like a W-2, where you would get that from your employer each year. Partners will get a K1, which will show their income of the business. You don't need to know how to fill this out or anything. I just want you to be aware that the partnership does not pay taxes. The tax return will show how much money is made. And then a K1 will be given to the partners, and the partners will have to put that income on their tax returns. Partnerships have to be mindful of government regulations. This is still considered an advantage over forming a corporation. The government regulations for partnerships are a lot easier to follow than it would be for a corporation. A concept that's considered a disadvantage for a partnership is called mutual agency. We did briefly discuss this in another chapter. I'm not sure if you remember or not, but mutual agency means that each partner can act as an agent for the business separately and independently. Meaning, if I have a partnership with someone, my partner can go out and sign loans, sign deals, get into contracts without me being present. It's considered a disadvantage because they can act beyond their authority. Another one of the disadvantages would be unlimited liability. This is a disadvantage over a corporation. A corporation has limited liability, if you can remember. This means that if I invest in a business that goes under, I might lose my investment, but that's it. My personal assets are protected. Unfortunately, for a partnership, it works the same way as a sole proprietorship. Whereas if the business goes under and we get sued or we owe all this money to our creditors, my personal assets would be at stake. This is what unlimited liability means. The liability for the business is unlimited. It's not just limited to the business, but it's unlimited, meaning my personal stuff is at stake. Another disadvantage is that a partnership does have limited life, similar to a sole proprietorship, but different from a corporation. A corporation has unlimited life, meaning if the owner passes away, the company can still continue going forward. Whereas with a partnership, limited life, usually when something happens to one of the partners, they do need to dissolve the business. Now, the partnership agreement can state otherwise, but just for boilerplate normal talk, that the partnership does have to dissolve, and then any remaining partners would have to start a new one. Next, we'll discuss the different partnership types, because you don't have to have just a regular partnership. There are a few different options you have depending on the type of business you have and the relationship you have with the other partners. Most of our examples are going to really just be a general partnership, but it's still good to know what the other types are. A general partnership, basically meaning everyone runs the business, all partners are involved, they all have the same responsibility for the partnership, for their debts, and for all the obligations in the partnership. Another type they can open is called an LP, a limited partnership. This is when there are general partners and limited partners. The general partners, I always say, think of like a general manager. A general partner is the ones who run the business, the day-to-day operations. They're the ones who are involved. They will have unlimited liability for the partnership debts. On the other hand, a limited partner, they are not involved with running the business. They're basically like investors. They will have a limited liability. That's why it's called a limited partner, because they have limited liability. Meaning if the partnership goes under, they might lose their investment, but their personal assets are safe. An example of this could be if one of you students has a great business idea and you need an investment, and I say, okay, here's some money, I believe in you, go start this business. And then you go and you run the business, and all I am is an investor. I have no say in the operations of the business. You're the one who's running it on a day-to-day basis. In the end, if something happens, you'll be the one who has personal assets at stake, at risk, where mine would be safe because I'm not the one running the business. Another form would be an LLP, a limited liability partnership. This is mostly for professional businesses where each of the partners has their own certification and pretty much practices their profession separately. For example, an accountant's office or a lawyer's office, a lot of doctors and dentists are set up this way. For example, when I go to see my doctor, there are multiple doctors in the office seeing their own clients, yet they share the space, they share the office expenses, they share the receptionist, yet they're all practicing separately with their own clients. If one of those partners gets sued for malpractice, the other partners are not at risk. That does not mean that they're not responsible for the debt of the partnership, but any malpractice claims would be only on that one specific partner. This last type is not a type of partnership. It's a hybrid between a partnership and a corporation. It's an LLC, a limited liability company. Members have the same limited liability as a corporation. That's one of the main advantages of a corporation, but it also has a limited life like a partnership. We're really not going to be discussing this one at all during this chapter because it's not a true partnership. Like I said, it's a hybrid between a partnership and a corporation. All the examples that we're going to be doing going forward, we're only going to be dealing with general partnerships. Next, we'll discuss the formation of a partnership. This is when two or more people, they get together, they say, hey, let's form a partnership. They each have to maybe put in money or different assets into the business to get it going. And they'll have to do journal entries for this. The first step is that each partner will invest assets at agreed upon value, basically the fair market value of what the assets are worth. For example, maybe if I had a business and someone I knew also had a business and we wanted to combine both of our sole proprietorships into one partnership, we might be bringing over our assets that we already have on our books into this new partnership. If something was worth a specific dollar amount on my books, it does not mean that same value is carrying over to the partnership. All assets going into the partnership will be reassessed for the fair market value. Also, each partner will have their own journal entry that you're doing. We are not combining all the partners into one journal entry. Each one will be done separate. Assets have a debit balance. Therefore, the new journal entry will have all assets listed with a debit balance. This is the journal entry for the partnership. If the partnership is getting all these assets, then they will be debits. For example, I just listed all the assets here in parentheses to show you would put the name of the asset in. If I contributed cash or a building and equipment and some accounts receivable I had, I would list them all right here. All of the assets you list as a debit because that's its normal balance. I could also carry over some liabilities. For instance, if I put a building into the business, there'll be an asset for building, but I might have a mortgage on that building. Therefore, that liability will also carry over. If I carried over accounts receivable, I might have allowance for doubtful accounts, all of the bad debts I think I will have. That also normally has a credit balance. Anything you're bringing to the business, into the new partnership, you want to keep it as the normal balance. If it's an asset, it'll have a debit balance. If it's a liability, it will have a credit balance. The last step is to total all this up. You want to total it up to see the value of this investment from the partner. Assets will increase the value of the investment and liabilities will decrease the value of the investment. Some partners might not even contribute liabilities to the business, therefore it would only be the total of all the assets. Basically, you want to add up the assets but subtract anything on the credit side. That would give us the partner's capital. You would use your last name. If it was me, it would be Kroeger, capital, and the value of my investment. We need to keep all of the different partners separated to know what the value of each of their investments are. I would do this journal entry for each partner that we have. Let's do an example. This is on your classwork. This is problem number 1. On January 1st, Michael Scott and Pam Beasley organized a partnership called the Michael J. Scott Paper Company. Michael's initial investment consists of $18,000 cash, a building with a fair market value of $80,000, and a note payable of $25,000. That's the first partner right there. The second partner, Pam's initial investment is cash of $31,000. We need to record Michael's investment and Pam's investment. Remember, we're going to be doing 2 separate journal entries, one for Michael and one for Pam. First, let's input Michael's investment. The date is January 1st. Take a moment to think of all the items that Michael Scott has invested into the business. What are the assets? His assets would be the cash and the building. We're going to put these items in. First, cash of $18,000. Next, Michael contributed a building, and we're going to use the fair market value of $80,000. Building, $80,000. These are assets, therefore they will be debits. If there were 2 values for the building, for instance, a value to Michael and then the fair market value, we would always go with the fair market value. What else has Michael contributed to the business? A note payable. A payable would be a liability. What side would this be on? It would be on the credit side. This reduces the investment because it's a debt to the business. The assets increase Michael's investment, but the liabilities will decrease it, offset it. Now we have to put in what Michael's investment is worth. The account name would be M. Scott Capital for Michael Scott, so we know that this account is his. To find the value, we total up all the assets, but then subtract the credit that offsets it. $18,000 cash plus the $80,000 building minus the $25,000 note would be $73,000. That would be the investment for Michael. That's what everything is worth combined together. Next, we'll do Pam's investment. Remember, it's a second journal entry. Take a moment to think what this journal entry would be. It's a little bit easier than Michael's. It would be cash of $31,000 she contributed, and that's all. Therefore, her capital account, P. Beasley Capital, would be the total of $31,000. That's all. Next, we'll discuss a few more journal entries. The first one will be for withdrawals. This is if the owner takes money out of the business. This is what partners do when they want to pay themselves or take out additional money. It's their business, whatever they have contributed into the business and whatever the business makes, the owners can withdraw that out. As a reminder, when owners put money into the business, it will increase their capital account. And when owners withdraw from the business, that will decrease their capital account. The journal entry would be the partner's name. For example, if it was me, it would be Kroeger, withdrawals, and then a credit to cash because cash is coming out of the business. Then at the end of the year, you need to close the withdrawals account to the capital account. Basically here, decreasing capital. Remember, capital is a credit account. You can always remember CC, C for capital, it's a credit account. When I do a debit, it means I'm taking it down. I'm bringing it lower, taking money out of that account. I'll get rid of the capital at the end of the year. So these cancel out. And it basically just gets withdrawn from capital. Next, we'll discuss net income and loss. This is a topic that we'll be covering for the next few slides. First, I just want to go over the journal entry, then we'll look at the amounts. A partner's capital account will be credited with net income, or it would be debited if there was a loss when closing the accounts out at the end of the period. I'm not sure if you remember from Accounting 1, but the account income summary, that's a summary of all the income. Basically, the step before this is closing revenue and expenses into this account and having income summary be a total of the net income, then closing this account to the capital accounts. This amount here in income summary would be the amount of net income for the year. And then you would split it up between the different partners. You would list partner 1, then the next partner underneath, and then the next one. We would do this all in one entry. I only have one partner's capital account here, but you would list them all, and you would divide this income between all of the different partners that you're listing here. This would be the entry if there was net income. If it was a loss, you would flip it. The entry would be reversed. Basically, the partner's capital accounts would be decreased if there was a loss. All of our examples we're going to do, there's only going to be net income. We're not going to do any losses. Next, we'll go over how we determine what each partner will be getting in income. I mentioned this in the last slide that if a partner wants to pay themselves, they'll do a withdrawal. That's because partners are not employees. They are owners of the business. Salary expenses are not going to be an expense that will offset the income here. Instead, it would be a withdrawal. There are different ways to decide how we're going to split up the income. A few of the methods, and there are more, would be one is using stated ratios. That's like saying, let's split it up 50-50 or 70-30, 70% to you, 30% to me. Or if we have 5 partners, let's just do it all equally. Having a specific percent would be the stated ratio. Another way would be based on capital balances. The partners with the higher capital amounts will get the most income out of it. We'll add up all of the capital balances and see how much each partner's capital is to figure out a percent. Another way is a combination. Salaries would still be considered a withdrawal, but we'll call it a salary to each of the partners. Then it could also be based on maybe a certain percentage of their capital as interest. A lot of companies do this to incentivize the owners for leaving money in the business. They'll give interest based on their capital. I might not withdraw money, I might leave some of it in the business so that it does earn interest. And then what's ever left over, we can split on a specific ratio. There are combinations of all of these together. These are just a few of the examples that we're going to cover. We're going to practice each one of these next. This is practice problem number 2. We have Superman, Batman, and Aquaman. They invested $80,000 for Superman, $112,000 for Batman, and $128,000 for Aquaman for the partnership, the Justice League. During its first calendar year, the partnership earned $249,000. The partners had withdrawals of $10,000, $5,000, and $20,000. Prepare the year-end entries to allocate the $249,000 net income to the partners under the following assumptions. In assumption A, the partners have no agreement on the method of sharing income and loss. When there is no agreement in place, it's just split equally between the partners. Since there are 3 partners, it'll be a third to each one of them. A few slides ago, I showed the journal entry. We start with income summary, and then we list all the different partners. We have 3 partners here. We'll list their capital accounts: Superman capital, Batman capital, and Aquaman capital. The amount for income summary is the total amount of net income, which is $249,000. Now we need to split this up between those 3 partners. Since it's equally, we'll do $249,000 divided by the 3 partners, which would be $83,000 each. Superman's capital will increase by $83,000, Batman's and Aquaman's as well. Then if they want, they can withdraw these funds out. Let's look at part B now. It's the same situation. In this case, the partners have agreed to share income and loss in the ratio of their beginning capital investments. Let's put in the journal entries. It's still income summary.
along with the 3 partners, Superman, Batman, and Aquaman. The total amount of income is still $249,000 to be split up. We're just going to split this amount up differently than we did in Part A. In this case, we have to look at the beginning capital investments. We'll look at the total investment and then each partner's individual investment and divide to get a percentage for each. Then we will take that percentage and multiply that by the amount of income summary, which is the amount of net income. The partner with the most capital contributed will get the most income. The partner with the least will get the least. Here is all of the capital I got from the beginning. Superman had 80,000, Batman 112, and Aquaman had 128,000 invested in the company. When you add this up, this is a total of $320,000. We want to take each of the investments and divide it by that total. For example, Superman's $80,000 investment divided by this total of 320. Then we'll do Batman's 112 divided by that 320, and then Aquaman's 128 divided by that 320. Each one will give us a different percent. Superman's would be 25%, Batman's is 35%, and Aquaman's is 40%. We're going to take these different percents and multiply it by the total income of $249,000. 25% of $249,000 is $62,250. That's how much Superman would be getting. Batman's percentage would be 35% of that income, which would be $87,150. Aquaman's would be 40%, which would be $99,600. You should also add up all the credits to make sure it equals the debits. This is a good way to check to make sure that you have the right amounts in there. Next, we have Part C, which is a little bit more complicated. We have a little table to help out with this. The partners agreed to share income and loss by providing annual salary allowances of $66,000 to Superman, $56,000 to Batman, and $80,000 to Aquaman. They are also granting 10% interest on the partners' beginning capital investments and sharing the remainder equally. This table is used to help us before we do the journal entries to figure out how we divide this income. The first line, let's put the total balance of the net income in, which is the $249,000. The next line is salary allowances. We'll give the salary to each Superman, Batman, and Aquaman as listed above. Superman's would be $66,000, Batman's would be $56,000, and Aquaman's would be $80,000. So the total's right there. We're going to add them up to get the total of salary to all three. When you add these up, you get $202,000. We have $249,000 to split up. So far, we've given out $202,000. What's the balance? That would be how much is left after we gave out the salary allowance. $249,000 minus $202,000 would be $47,000. That means we have $47,000 left to give out. The next line is the interest allowance. Interest is 10% of the beginning capital balances. This is listed in the beginning of the problem. I also put it here to reference it. These are the beginning capital balances. We want to do 10% of each of these and give it to those three partners. 10% of 80,000 would be 8,000. 10% of 112,000 would be 11,200, and 10% of 128,000 would be 12,800. Once again, we want to total these up to get the total. which is $32,000. We had a $47,000 balance, and now we just split up $32,000 more. Our balance after this would be $47,000 minus $32,000, which leaves us with $15,000. It says that the rest of it is shared equally, meaning this remainder of $15,000 needs to be shared equally between the three partners. How would we split up $15,000 three ways? It would be $5,000 each. 15,000 divided by 3, 5,000 to Superman, 5,000 to Batman, and 5,000 to Aquaman. A total of 15,000. The balance is now 0, and that's what you want for it to be 0. What we're doing is taking the full amount of income and dividing it amongst the different partners for the full amount. We're not going to do less than the income or more than the income. We're going to do the exact amount of it. The last part is just totaling it to see what the total is going to be for the three different partners. We're going to add up everything for Superman. 66,000 plus 8,000 plus 5,000 would be 79,000. Then we would do the same thing for Batman. It would be 72,200. And finally, for Aquaman, it would be 97,800. This chart really just helps us figure out how we're splitting it up amongst the three partners. The total is 249, which is what we want to give out. We always want to give out the full balance. The final balance is now 0 because we did give it all out. The journal entry is done the same way as in part A and B. We'll first list income summary and then the 3 capital accounts. We'll put the full amount of income into the debit spot. And now we'll put what we just did for part C here, the totals for Superman, Batman, and Aquaman, into the credits here. Superman, Batman, and Aquaman. The journal entry was done the same way for parts A, B, and C, but how we split up the money, that's what was done a little differently. Once you're done allocating the income to the partners for the year, you want to create a capital statement, which is basically a summary of how the capital account changed from the beginning of the year to the end of the year. You would increase the capital account when the partners invest money into the company or other assets, and then when the company earns net income. That will increase the partner's capital accounts. What will decrease the accounts are when the partners withdraw from the company or if there's a net loss. Obviously, there's only going to be either a net income or a net loss, not both. This is what it looks like. I made one sample for one partner. You start with the beginning capital of the beginning of the year. Any of your additions you put in here. If there is a net income, you add that partner's share, along with any new investments the partner made, if they did make any. You're not going to be using all these lines. Total it up, and then do your subtractions. If the partner withdrew money from the partnership, that would go here. And then if there was a net loss, that would also be subtracted from it. Like I said, you're not going to have all of these lines. Like you would not have a net income and a net loss at the same time. You would have one or the other. Once you total everything up, that would be their capital at the end of the year. Let's do a practice problem with this. This is your classwork, letter D. Prepare a capital statement for the Justice League under scenario C, which was the last one we did. This is what the capital statement looks like. For the 3 different partners, we have the beginning capital. We're going to add our net income to it and then total it. And then we're going to subtract the drawings to arrive at the ending capital balance. To start with the beginning capital, that comes from the beginning part of the problem. The beginning capital was 80,000, the 112,000, and the 128,000. We will put that in first. We will add the 80,000, the 112,000, and the 128,000 into the capital statement. The next step is to add the net income, and remember we're using Part C's information for this. Here's Part C. This is the income we're able to allocate to the different partners. We'll put in $79,000 for Superman, $72,200 for Batman, and $97,800 for Aquaman. We'll put those totals in. Now we want to add up these numbers. We'll add the 80 and 79,000, the 112 and the 72 too, and the 128,000 plus 97,800 to get a total so far. 159 for Superman, 184,200 for Batman, and 225,800 for Aquaman. Once the additions are done, we're going to do the subtractions, which would be the drawings, all of the withdrawals that each partner made. And once again, this comes from the beginning information. The withdrawals for each partner were 10,000 for Superman, 5,000 for Batman, and 20,000 for Aquaman. We'll put these three numbers in as subtractions into the capital statement. 10,000 for Superman, 5,000 for Batman, and 20,000 for Aquaman. It says less here, and we're going to subtract that from the total we just calculated. 159,000 minus 10,000 is 149. 184,200 minus 5 is 179,200. And 225,800 minus 20,000 is 205,800. It's important to keep track of the capital because, as we saw in one of the examples, interest could be based off of the capital balance, or even just how they split up their income in Part B was based solely on capital. It also makes a difference when we admit new partners, withdraw partners, or liquidate the company. This is very important to keep track of. We do this for our clients. I do have an example to show you of a capital statement I made for a client. This is a capital statement I made for a doctor's office. I just took out the names for confidentiality reasons. We have a company, we call it the capital accounts, and this is as of December 31st, 2017. I have Dr. A and Dr. B, and then a total for all of them. We start with the additions. The capital balance at the end of last year would be the capital for the beginning of this year. We're going to add the income to it, and this is how we split it: 46.16% to Dr. A and 53.84% to Dr. B. We add this up. Their total income for the year was a little bit over 1.2 million. Dr. A got 583,000 of that, and Dr. B got 680,000 of that. Added together to get our first total. Then we do the withdrawals. In this case, we have some extra things. You don't have to worry about this in terms of the class, but I just want to show you with my example. They had a profit sharing plan that the company paid for, but it comes out of their capital account, $53,000 for each. The withdrawals, this is them taking money out of the business, either as salary or bonuses or payments. 535,000 to Dr. A, 614,000 to Dr. B. Dr. B also has auto expenses taken care of, meaning the company pays some of their auto expenses, but it comes out of their capital account. It's considered like a withdrawal. In this case, I totaled all the withdrawals up, and I did the total additions minus the total of subtractions equals their balance at the end of the year. Now we will discuss how to add new partners, and next we'll discuss how to withdraw partners. However, in this first slide, this first topic, it will be a combination of the two because we're going to remove one partner and add a new one in at the same time. So it kind of covers both topics for a moment. When the makeup of a partnership changes, that is, the owners change, the existing partnership is dissolved and a new one is formed. Like I said, there are multiple ways to admit a new partner to the business. The first way we'll discuss is by replacing an old partner with the new one. The cash that's paid will go directly to the old partner that's leaving. no cash is going to be passed through the business. What the business is going to do is remove the capital account of the partner that's leaving and replace it with the capital account of the partner that's coming in. The journal entry will look like this. There'll be two capital accounts, one's a debit, one's a credit. The partner that's leaving, their capital account will be debited for the amount that is in that account, basically removing it and zeroing it out so that partner is no longer on the books. The capital account that gets the credit will be the new partner for the amount that's being replaced with the old partner. For example, if partner A is being removed and they had a $100,000 capital, we'll add partner B with that $100,000 capital account. Let's do a practice problem with this. This is the next one on your classwork, number 3. The partners in Wheels and the Legman have agreed that partner Steve Smith may sell his $100,000 equity in the partnership to Roger Smith, for which Roger will pay Steve $85,000. Prepare the journal entry. In this case, Steve Smith is getting out of the business and Roger Smith is replacing him. Roger is getting a $100,000 equity investment in the business, but is only paying $85,000 for it. Like I said, the cash does not matter in this specific type of scenario because the business is only going to replace one account with the other. Steve is getting the cash here. Steve is obviously getting less than what he had invested in the business. He is taking a loss, but that happens sometimes, and sometimes it's in the opposite direction. But in this case, Steve is taking a loss. Maybe he really needs money or really wants out of the partnership, but he's willing to take a loss. We don't care about that. That won't affect our journal entry. What we need to do is remove one partner, the partner that's leaving, which would be Steve Smith, S. Smith Capital. His capital or equity in the business was $100,000. That is what we are removing. The second entry would be the new partner that's being admitted to the business, which is Roger Smith. We will make a new account, R. Smith Capital, to put Roger on the books, and he is just taking over for Steve Smith for that $100,000. Once again, the $85,000 is irrelevant in this scenario. Another way to add a new partner to the business would be by them investing assets into the partnership. In this case, the consideration that the partner pays will go on the company books. The new assets will increase whatever the new partner will give to the business. And after that, their capital account will also increase. This part gets a little tricky. I'd say this is one of the more difficult parts of this chapter. We need to calculate the value of the investment. If they just give a straight $100,000, we don't put them on the books for their capital account for a straight $100,000. We have to see what percentage of the business we're going to give them and what the value of that money brings and what their capital account should be based off of that. Like I said, it gets a little confusing. We have to follow this formula. We will take the investment that the new partner is giving, whatever the value of that is, and add it to the capital of all the other partners. We will take that and multiply it by the interest percent that we're giving that partner. What percentage of the business are they getting by giving us this investment? When you do that, that would be the value of the investment. From there, we have to see if it's going to be a bonus or no bonus. Whatever that new partner is giving their investment, if it equals the value of their investment, there's no bonus. They're giving exactly what they should be giving in order for that percentage, and they get the same percent as everyone else. It's kind of like everything's equal. I'm giving $100,000 and the value of that investment is $100,000. Now, if the investment that they're giving is more than the value of the investment, like I'm giving you $100,000, but my capital is only going to be 80,000. That's because there's going to be a bonus to the old partners. The old partners will get a little bit of extra, while the new partner coming in maybe is losing a little bit. On the other hand, their new investment could be less than the value. I always say this is more like a Shark Tank scenario where they'll bring on the sharks as an investor and they give them a better deal than what other investors would be getting because they bring something extra to the table. In this case, there's a bonus to the new partners. Maybe they're giving $100,000 investment, but they're getting $120,000 worth of capital. They're getting more out of it in the end. We're going to practice each one of these scenarios next. This is your classwork number 4. We have Cartman Land, a partnership that has total partners equity of $510,000, which is made up of Cartman's capital of $400,000 and Marcia's capital of $110,000. So there's 2 partners right now. The partners share net income and loss in a ratio of 80% to Cartman and 20% to Marsh. On November 1st, Broflovsky is admitted to the partnership and given a 15% interest in equity and a 15% share in any income and loss. Basically, Broflovsky will be a 15% partner. Prepare the journal entries to record the admission of Broflovsky under the following assumptions. In Part A, record the admission of Broflovsky with an investment of $90,000. In this case, with a $90,000 investment, we have to see if there's no bonus, a bonus to the old partners, or a bonus to the new partners. We have to follow that formula that was shown on the last slide. I copied over some of the information from the problem here, along with the formula to follow. The new investment by Broflovsky is $90,000. We're going to add that to the previous capital of the $510,000. When we total that up, we get $600,000. We will multiply that by the interest percentage. That's the amount we're giving the new partner, which is a 15% interest. 600,000 times 15% equals 90,000. Broflovsky is giving 90,000, and the value of that investment, what it's worth for the capital account, is 90,000. The new investment, 90,000. The value of the new investment, also 90,000. Since it equals, there's no bonus to a new partner or to an old partner. The capital that Broflovsky is getting is the exact same as the investment he's giving. The journal entry for this is actually pretty easy to do. The company is getting the cash, it's getting the asset, therefore cash will be debited by 90,000 because that's how much the business is getting. We then also need to add the new partner onto the books. We have to put Broflovsky's capital account down. And because the investment is worth the amount he's giving, the capital is also 90,000. We're going to be going over the other scenarios next where they don't equal and that there are bonuses. For instance, in Part B, record the admission of Broflovsky with an investment of $120,000. Everything else is the same. We're going to use the same formula to figure this one out. The new investment this time is $120,000 instead of $90,000. We're still going to add that to the previous capital of $510,000, which gives us a total of $630,000. Multiply this by the interest percent, which is 15%, gives us a total of $94,500. The new investment is $120,000. The value of that investment, the amount of capital that Broflovsky is getting, is $94,500. In this case, his investment is more than the value of the investment, meaning that there's a bonus to the old partners. This extra amount that Broflovsky is giving is going to end up going to the old partners and increasing their capital account because they're getting bonuses with this extra money. I'll show you how to do the journal entry for this. The journal entry starts the same way we did it in part A. First, we input the cash of $120,000 that the business is getting. We're going to add Broflowski's capital account to the books, but it's not going to be for 120,000. It's going to be for the value of the investment, which we calculated to be 94,500. The cash is higher than what the investment is. As I just said, this extra amount that Broflowski is giving in cash is going to be a bonus to the old partners. Their capital accounts are going to increase. I'm going to add the old partners on here, Cartman and Marsh Capital. Now they increase the same way that they split up income. Currently, Cartman gets 80%, while Marsh gets 20%. The extra money that was given was 25,500. There was cash of 120,000 given, but only a $94,500 investment was put on the books. When you subtract the two amounts, you get 25,500. This is the amount of the bonus that's going to the old partners. Now we'll split this amount up, 80% to Cartman and 20% to Marsh. When you multiply 25,500 times 80%, you get 20,400. When you multiply 25,500 by 20%, you get $5,100. So in this scenario, Broflowski was put on the books for 94,500, but he had to give 120,000. That extra 25,500 ended up going to Cartman and to Marsh. Both their capital accounts have increased. Let's see the last scenario for this in part C. Same information, except for in this case, Broflowski is giving an investment of $80,000. In this situation, the new investment is 80,000. Add that to the previous capital of 510,000, and the total is 590,000. Multiply this by 15%, and we get 88,500. The new investment was 80,000, but the value of that investment is 88,500. In this case, the value of the new investment is greater than the investment itself. Broflowski only has to give 80,000, but he will have a capital account of 88,500. This is the bonus to the new partner. Where does this extra capital come from? It gets deducted from the previous owners. The other two partners will lose this extra money and give this bonus to the new partner. Like I said, this would be a Shark Tank scenario where we're getting some very great investors, someone we really want on. Maybe they have a lot of experience and we want to give up some of our capital to give them a better deal because of how valuable having them as a partner is. The journal entry is pretty similar to part B. First, we enter the cash. How much cash is Broflowski giving the business? 80,000. Next, we have to put Broflowski's capital account on the books for the value of his investment, which we calculated to be 88,500. Remember, in this case, the cash amount is less than the capital. In part B, the old owners got extra money. In this case, they'll be losing it. Instead of doing a credit to the old owners, we're going to be doing a debit to the old owners. Their capital will be going down. We have Cartman and Marsh as the old owners. I'm putting them on the books as a debit. So like I said, it will reduce their capital. To figure out the amount, it's the same thing we did in part B. Find the difference between the value of the investment and the cash amount, which would be 8,500. We split that up the same way, where it'll be 80% to Cartman and 20% to Marsh. 8,500 times 80% would be 6,800. 8,500 times 20% would be $1,700. That is what Cartman and Marsh are both losing in order to have Broflowski as an investor. Next, we're going to discuss withdrawing a partner from the business. There are two ways to withdraw a partner. The first way we have already discussed. This is when a new partner comes in to replace the withdrawing partner. The second way is when the partnership distributes cash or assets to the partner that's withdrawn. Basically, the partnership is buying them out, giving them back cash or assets to help replace their capital, and removing them from the books. There are 3 steps involved for removing the partner in this second way. First step is to remove the withdrawing partner's full capital by doing a debit. Remember, capital accounts are credit, CC, C for capital, C for credit. So if we're removing them from our books, we want to do a debit for the full amount, regardless of what we're actually giving them. The second step is to pay out the assets. Usually it's going to be cash, but you can give them property instead, but we're really just going to deal with cash. Since the partnership is spending the cash, cash will get a credit. Remember, it might not be the full amount of the capital. Maybe we're paying them extra to leave, or we're paying them less than their capital. The third step would be if there is a difference, that would be split among the current partner's capital accounts based on the income ratios. So if we're giving them less money than what their capital account is, that extra money that they're not getting, that basically they're losing, will go to the old partners kind of as a bonus. If we had given them extra money to leave, which usually isn't the case, the capital accounts of the old partners will be debited. It'll be removed from them. But that's usually not what we're going to see. So we're kind of going to follow this example here where the partner that's leaving gets the debit and the partners that are staying on will get a credit showing that their accounts are increasing by that extra amount that the old partner is losing. We'll do an example to illustrate this. This is the next one on your classwork, the last one you have, number 5. We have Griffin, Quagmire, and Swanson, who have been partners, and they share their income in a 5-3-2 ratio. What this means is that when you add it all up, 5-3-2, it equals 10. Griffin gets 5 out of 10, so half. Quagmire gets 3 out of 10, 30%. And Swanson gets 2 out of 10, 20%. It's just a different way of explaining this. So in this scenario, Swanson retires from the partnership. This partner, Swanson here, he is leaving. The current equities are Griffin has $150,000 invested in the partnership. That's his capital account. Quagmire has $90,000 and Swanson has $60,000. Assume Swanson is paid $30,000 for his equity using partnership cash. If you think about it, Swanson's capital is worth $60,000, but he's only going to get $30,000 for that. He's losing basically $30,000. To do this journal entry, we'll follow the steps I just laid out. First, we get rid of Swanson's capital account by doing a debit to his capital account in the full amount that he has. He has a $60,000 account. He is no longer a partner. We want to get rid of that whole thing in order to remove him from our books. How much cash are we giving him? We are giving him $30,000 cash. As you can see, my debits and credits don't equal. They are off by $30,000 because he is basically losing $30,000. That extra money is going to go to the old partners. We have Griffin and Quagmire as the old partners that will be getting this extra bonus. The difference between the two is $30,000. That's how much bonus that the old partners are getting. That's how much Swanson is losing by leaving this partnership. We just have to figure out of that $30,000, how much does Griffin get and how much does Quagmire get? With Swanson gone, his part of the ratio is removed. We're only left with Griffin gets 5 and Quagmire gets 3. It's a 5-3 ratio. Griffin gets 5, Quagmire gets 3. How you do this is you total it up, which equals 8. So basically, Griffin gets 5 out of 8, which is 62.5% if you do 5 divided by 8. You do the same thing with Quagmire. 3 out of 8, which would be 37.5%. We'll take both of those percentages and multiply it by that $30,000 extra money that Swanson is losing and that the old partners are getting. 62.5% times 30,000 equals 18,750. Do the same thing for Quagmire. 37.5% times 30,000 equals $11,250. That's how you do this problem. I know this is long, but we're almost done. We have 2 quick topics left. One is if there is a death of a partner. If this happens, a partner's death will dissolve the partnership. The deceased partner's estate is entitled to receive any equity that they're due. So basically, anyone who's listed in the will get their share of the assets for dissolving the company. The partnership agreement should contain all provisions as to what to do in case this happens. It can involve settling the deceased partner's estate by selling the equity to remaining partners or to an outsider, or it can involve withdrawing of assets. It really depends on what the partnership agreement states. Last topic is the liquidation of a partnership. I used to make my students do all the journal entries and figure out the amounts for this, but we've added a lot of topics to this chapter already, and I think it's already kind of overwhelming as is. So right now, I just want you to know the 4 steps in dissolving a partnership, but I'm not going to have you do the journal entries for it. The first step is to sell all non-cash assets, basically all their stuff. All their assets need to be sold. The only thing that's not is cash. Cash stays where it is. But everything gets sold and the cash account will increase, and you'll sell everything at either a gain or loss, because you'll either be losing money on the sale or gaining money, or maybe it'll be the exact same, but that's usually not the case. Step 2 would be taking that gain or loss and allocating it to the partners based on their income and loss ratio. If they split it 3 ways, we'll split that gain or loss 3 ways. Basically, we'll add it or subtract it to their capital account. Step 3 is to pay off all liabilities. Use the cash account to pay off any of the debt that the company has. After this step, all of the assets are gone except for cash. All of the liabilities are gone. The only thing that's left would be the cash and then the capital accounts. We'll take the remaining cash and give it to the partners based on their capital accounts. Once we do that, there's no cash left, there's no capital accounts left. Everything is gone, all the accounts are at 0, and the partnership is closed. And that concludes this PowerPoint for Chapter 12 on partnerships. If you have any questions, please let me know. I hope you all have a great week. Thank you.